Hello and welcome everybody to this week's weekly market recap for the week ending Friday, November 21st, 2025. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be with all of you again this week. Kind of a crazy week in the market. I mean, we had a lot of volatility. The VIX moving up into the 20s. That's always a problem for the market. Always shows a lot of nervousness, which can lead to much more accelerated selling. And we saw some of that last week. Got a big bounce back, though, toward the end of the week, which was nice. Really hard to say. I mean, it looks like things are teetering, like we want to go lower. But there's a lot of volatility, over whether or not the Fed is going to cut in December. Middle part of the week, it looked like the odds were very, very low and shrinking. And then by the end of the week, started to get more enthusiasm for a rate cut. I think the odds by the end of the week were back up to about a 72% chance. I've been seeing, a lot of rotation in the market that would suggest that we're not going to get a rate cut. But then a lot of those things reversed on Friday, and all of a sudden looks like maybe we will. It's going to be really interesting going into this meeting. I think it's on December 10th, I think is when we'll get the announcement. So we've only got like a week and a half to go. Or actually, I guess we got 2 weeks, week and a half after we get back from the Thanksgiving holiday, which, by the way, we're going to have a holiday shortened week coming up. So, I mean, there's a lot going on. We got the jobs report, the one from September. They're not going to issue an October jobs report, but the one from September came out, and it was stronger than expected, which is a good thing and maybe a bad thing if you're hoping for a rate cut. But then we had the government shutdown, which most economists, I think, would agree is going to cut into the GDP. We also saw that the unemployment rate jumped to 4.4%, which is the highest we've seen in a while. So it seems like we've got things pushing from both sides. And it's really, I would say, a confusing market. But I do like to just kind of take a step back and look at the big picture. And the big picture to me still says secular bull market and higher prices down the road. So I'm not sure exactly how we get there, whether we have another pullback. If we don't and we can reverse higher from here, there are some other signals I'm going to talk about with our Earnings Beats members in the weekly market report on Monday. But there is one big change that is taking place under the surface of the market. And I do want to reserve that for our paying members. But look for that in the Earnings Beats weekly market report this week, and it'll be out there tomorrow. But that just adds more questions, I think, as we go into year end. I think I saw something where the NASDAQ down 6% so far in the month of November. Normally, November is a great month. It's the best month over the last 20 years. It's the best month since this secular bull market was confirmed back in 2013. And yet everything just seems to be turned upside down. So anyway, I wish I had a lot more clarity for you, but I mean, the market's really not providing a whole lot of it. But let's go ahead and take a look at what happened last week, and we'll kind of go from there, go through all the charts with you. Last week, you can see the major indices all in the red, although transportation stocks did only lose about 1/3 of 1%. Big rally on transports on Friday. Again, areas, small caps that had been going down, regional banks, home builders, transports. I mean, these areas were suggesting to me that, hey, we're probably not going to get a rate cut. And then they all exploded on Friday and led the market on the rebound. So I think that there's still just a lot of indecision in the market. And, with the volatility as high as it is, it's going to make it a little tough, to make a whole lot of headway or to feel very confident, whether you're on the long side or the short side. I think it's really hard to be overly confident in your position right now because of all of the indecisiveness, the high volatility, the back and forth action, the money rotating out of interest rate sensitive areas and then back in. But anyhow, you can see last week on the NASDAQ, pretty rough, down 3%. S&P 500 down almost 2%, same as the Dow. But again, Russell 2000, because of that big Friday, only lost about 0.8% for the week. Looking at the sectors, Technology, energy, consumer discretionary were the three that lagged the S&P 500. So again, S&P down almost 2%, discretionary down 2.33%, energy down 2.8%, technology down 5.2%. And technology recently, when I looked, was 36% of the S&P 500. So when more than 1/3 of the index has a week like technology had last week, that is going to lead to some losses, and that's what we saw. Three areas, though, did actually gain ground last week: healthcare, consumer staples, and a little bit of a surprise, communication services. But I did see internet stocks did well last week, and that helped carry that aggressive communication services group to some pretty decent outperformance. But the big winner last week, no doubt, was healthcare. Saw a lot of areas within healthcare that picked up, gained steam. I'll talk about some of those areas in just a bit. So let's talk about the major indices. Dow Jones. We made a major breakout above 45,000, which was an inverse head and shoulders. It measured to 53,000. I talked about this back in August when we made this breakout right here, fourth week of August. We were well on our way, went up through 48,000. And now just in the course of about the last 6-7 trading days, we've made our way. We went all the way back down into 45,000s again. I really think it's important that the Dow hold on to about 45,000. That was a major breakout level. If we go down to that level, I think we're just testing price support, which is no big deal. If we go below that level, we're already back below the 20-day and the 50-day moving average. Losing 45,000 would be a major negative for the market in the near term. S&P 500. Now, I pointed out in the past the head and shoulders top that was taken out. We lost neckline support on the IWM, small caps. Well, here are your large caps, S&P 500. And with the move down on Thursday, again, we bounced back a little bit on Friday, but we've got kind of a ugly looking head and shoulder pattern. If we do rally, last time I looked, futures are up for Monday morning, not a lot, maybe around 0.5% or so, depending on which index you look at. But if we do see some short-term strength, keep in mind this could be just a right shoulder. And I think what could be a problem is if the market starts to bounce thinking we're going to get a rate cut, and then everybody starts to think, well, maybe we're not, or eventually we're going to find out on December 10th. But I think if the Fed disappoints, I think that could easily result in this kind of action, another move to the downside. And a break of this neckline, which would be around 65.25, I think would potentially measure down to what would then become a 10% correction and a test of what used to be major resistance at 61.44. We broke out above that key level of resistance back at the end of June, and we haven't really gone back and tested that level. So this head and shoulder, if it does play out, just keep in mind a breakdown could take us back all the way to that 61.44 measurement. I still look at that as an outside possibility. I'm not really expecting that, but it's always good to be aware of the patterns that are setting up. And even if you're bullish, which I am longer term, you've still got to be aware and open to the possibility that the Fed maybe does something again. We've got a history of this over the last several years, but the Fed could maybe start waffling again, which we've seen in the past. The market doesn't like that. Something to at least be considering and thinking about. S&P 500, what I wanted to do here is just show you that the S&P, as we were going up, here are the aggressive groups. And you can see technology just absolutely on fire, beating the S&P 500 by a wide margin. That makes it really hard when 36% of the S&P 500 is crushing the S&P 500. Then the other 10 sectors, it's going to be really hard to get a lot of relative strength in those areas. And that's really what we saw. Consumer discretionary mostly flat. Communication services, we saw some strength and then weakness. Industrials and financials have both been downtrending quite a bit. They started to turn back up again here in November, and they usually do turn up in November on a relative basis. So we're seeing some of that. But really, since the market topped and started to roll over, you can see a lot of it has been driven by a very, very weak technology group. Now, I'm kind of bullish because I like the fact that the most aggressive area of the market was setting new relative highs at the last high on the S&P 500. So it's not like there was a lot of rotation. It wasn't like Wall Street was positioning out of technology and moving into more defensive areas at the top, like we saw back at the beginning of 2025 and like we saw at the beginning of 2022, both of which resulted in cyclical bear markets. That's not really what's happened here, which is why I tend to maintain a little bit more bullish beliefs than bearish. But again, I'm not going to ignore head and shoulder breakdown on the IWM and a possible head and shoulder pattern developing on the S&P 500. We need to be aware that they're out there. Anyway, definitely a mixed bag. And hey, if you're confused about the market, join the club, because honestly, it is a pretty confusing short-term market, no doubt. Here is the S&P, same chart, S&P, but on the bottom here, I've got all of the defensive groups. Now look at the defensive groups, all for the most part going down through the end of October. So utilities jumping up a little bit, and we started to see healthcare jumping. Healthcare, November has been really strong for healthcare. But again, that's when the market's pulling back. We're seeing profit taking in technology. So there's a lot of money to go into other areas. Just because you're breaking out on a relative basis doesn't mean you're breaking out on an absolute basis. However, there is some very bullish action taking place on the absolute charts, industry group charts within healthcare. And again, we'll talk about that in a bit. NASDAQ 100 moving up, pulling back. I see a similar type pattern to what I annotated on the S&P chart. Looks like maybe a slight downtrend in this neckline. Is it just going to be a false breakdown and then we jump right back up? If that's the case, we want to see money rotating back into aggressive areas. If we get a weak bounce coming up here over the next week, week and a half, get back up to the moving averages, struggle to get through, volumes light, on that move to the upside, we don't really see the aggressive groups leading. To me, that sets us up more likely for another move to the downside and possibly a break of head and shoulder necklines. IWM, small caps, strong through the end of October. On a relative basis, this was an area of the market that was really weakening over the last few weeks. But again, Friday was a big move back up on a relative basis in the small cap area. And so we'll see whether or not that continues into next week. If it does, then I think we might be back on with this interest rate sensitive group. Maybe the Fed is going to cut. If we see money rotate away from the group and the small caps start to underperform, then I would be thinking, hey, Wall Street is starting to signal no rate cut. But again, last week we were all over the place on the odds on whether we were going to have a rate cut or not. So a lot of indecisiveness in the market right now. Transports looked like transports just rolling over. I said, hey, we lost that 20-day moving average. Looked like we were going back to the bottom of the trading range, which is around 15.1 at the low to about 16.5 at the high. Looked like we were breaking down. I said, hey, 15.1 probably in play again. Nope. Friday, big reversal back to the upside, back above both the moving averages. The only thing that all of this confirms is that we're just sideways consolidating in the transports right now. All right, I do want to mention Bitcoin. Cryptos have been under tremendous pressure since even before the stock market topped. Back in early October, that's when Bitcoin was up to about 125,000, was setting all-time highs. Well, it's lost $40,000 in the last 6 weeks, 1/3 of the entire market cap of Bitcoin down in 6 weeks. So it has been a very, very big decline. And we're seeing that in a lot of the areas of the market. Just it's been more of a risk off type of an environment. So the question is, can we rally back? Of course we can. But I have a bigger question. That is, if and when we do rally back, can we get back through the 20-day moving average? Or do we need to go down one more time, perhaps move into the 75, 77,000 area, test that 52-week low, and maybe put in some sort of a positive divergence on that low, similar to the one we had back in April, where we put in a lower low, had a higher PPO, and that marked the bottom. Right now, you can see the PPO is just going down with price. Usually when that's the case, any kind of a rally, we fail at the 20-day and roll back over. We'll see if that's the case. And the other cryptos, by the way, kind of looking very similar to Bitcoin. Just everything's in a downtrend right now. Volatility index. I tell members all the time, I've talked about it on my shows, written about it. When the volatility index is above 20 and rising, you have to be careful in the market, especially when you've got bearish patterns setting up. Now, if we can turn this thing around, and I've had folks write in and say, well, Tom, when the volatility index tops, that's when you want to get in the market, into the stocks. I've said, I completely agree. But how do you know when it's topping until it actually tops? You might think, a week ago, you might have said, hey, that was the top when it tried to go through 20 and it failed. And it went down for a couple of days, but then it came rallying right back up again. And we've seen the market lose a lot more ground. My problem when the VIX is above 20 is that if the VIX goes from, say 10 to 15, goes up 50%, you don't lose a lot in the stock market historically. But if you go from 20 to 30, which is also a 50% increase, from 20 to 30, normally the stock market is getting killed. So it's just that when the volatility is up there, the risks are greater. And everyone has to ask themselves, am I willing to take on this additional risk in the market? And unfortunately, I can't answer that question for everyone. You've just got to decide. I love the long term for the stocks, for the market. I don't believe we're going to be in any kind of a long-term secular bear market for probably 6 to 8, maybe even 10 years. I believe the market's going to continue to rise with pullbacks, occasional cyclical bear markets along the way. But anytime the volatility index goes through 20, I think you have to be really careful and just nimble as a short-term trader. So I normally sit in cash and I pick my spots. And I'm not really doing anything different this time. I do have a few positions, but I've got a lot of cash just kind of watching, making sure this thing doesn't get out of hand to the downside. Technology. So let's take a look at technology because this is obviously the big driver of the market. The XLK, you can see definitely a downsloping neckline. There's no denying that the low that we just set on Thursday, and look at Friday, the XLK didn't bounce back like small caps. It didn't even bounce back as much as the S&P 500. So this is still an area that's weighing on the market. And until technology goes, I don't think we're going to see the stock market go. So this chart right here to me looks a little bit bearish. I think the levels to watch are right where we finished on Friday. That's the first key level of support. I think if we lose 270 on a close, then I think we're probably looking at possibly testing about the 257 area, which is where we had you can see all these green arrows. Very solid price support there. 4 different tests where we went below that level and reversed and held. So definitely going to be watching that if we do see more weakness. If that's lost, that's where I could see maybe going all the way back down into the lower 240s. And that would likely coincide with the S&P 500 moving back into that correction territory, perhaps reaching that measurement on that head and shoulder all the way down below 6,200. So I think technology is going to hold the key. Now, that chart looked horrible. Let me show you a long-term weekly chart. Now, if you know much about the market, you know that when we're trending higher, usually the 20-week moving average holds is great support. Well, we pulled back. We tested that last week, closed right at about that 20-week moving average. If you go back and you look, 2021, look at all these positive, bullish, successful tests of the rising 20-week moving average we had. Every time we hit it, that was the time to get in. Then we had the bear market. We mostly trended below our moving averages. And then again, 2023 started moving up. notice we tended to hold the 20-week moving average. And with the exception of earlier this year and last summer, when we had that little 4-week pullback in technology, outside of those two periods, for the most part, we trend above the 20-week moving average. So, are you bullish or bearish? I'm going to stick with my long-term call, which is bullish. That's going to be my default, but I can remain bullish long-term, and we could still have a little bit more weakness short-term. So we've got to watch these levels. We've got to watch the XLK, the recent, that price support, those 3 price support levels I gave you. We've got to watch this rising 20-week moving average, because this 270 20-week moving average comes right into where that initial price support level is, where we broke out right here. Something to keep an eye on. Healthcare, I wanted to mention this because look at this breakout. This thing has been really nice, not just on a relative chart that I showed earlier, but look at this absolute chart. Great action here on the XLV. And I'm going to show you how you can scan for some stocks in this group that I think are solid in just a minute. First, I want to mention a couple things. If you're new to earningsbeats.com, come over to our website, earningsbeats.com, both plural. Check out the hat. Got the hat on today. Earningsbeats.com. You can check out our 30-day free trial. You do have to give a credit card, but we will remind you at the end of the 30 days. Make sure you know that you're going to be charged if you don't cancel. So we will get back, reach out to you on that. I also want to mention that through December 1st, we are now running our fall special. Best deal of the year. So if you want to try us out, this is a great time to do it, because if you start your trial, 30-day trial, and between now and December 1st, you like what you see and you want to take us up on the fall special, you'll get 14 months for the price of 12, and the 14 months will go at the end of your trial. You won't lose the rest of your free trial. That's really important. I want to make sure you understand that. So if you start a trial and you like the service, you can then tack on 14 months to your already 1 free month. So really it's 15 months for the price of 12. Not going to get a better deal from us than this. So make sure you check that out. If you want to just, you're new to Earnings Beats, you want to learn a little bit more about us, I would suggest that you follow us on our free newsletter, our Earnings Beats Digest. Name, email address, all it takes. Hit that subscribe button. I got a stock that I bought on Friday. I absolutely love it. I have a certain strategy with earnings. This one fits perfectly to a T. Now, of course, if the market falls apart, of course, a lot of stocks are not going to hold support, but this one is at a major support level. We're sending it out in our EB Digest Monday morning. So name, email address, will get you that. Make sure you hit that subscribe button. Also, just a quick reminder to like our video, subscribe to our channel. We do a lot of free live stream shows. And so if you're subscribed to the channel and we do have a free live stream and you've got your notifications turned on, YouTube will let you know when we start a live stream show. All right, here are the small caps relative to the S&P 500, IWM, S&P 500. And then we've got regional banks relative to the S&P and home builders. So what I wanted to show you here is that at the end of 2024, this is an 18-month chart. So at the end of 2024, we saw all 3 of these groups starting to show relative strength, varying degrees, but all of them came off of relative lows, started moving higher. And then in November, even before the final rate cut that we got, we started to show relative weakness. And that continued for several months. And remember, that's when the Fed said, oh, never mind, we're not going to cut anymore. We're now going to pause. We're going to leave rates higher for longer. And all of those interest rate sensitive stocks that were showing leadership went the other way. Well, this is the sequel so far. We've got in August, you can see again, varying degrees of relative strength, but IWM moving up relative to the S&P. Regional banks, a little bit more sideways action, but we did see some strength heading into September. And then you can see the home builders over about a 3-month period were starting to show strength. All of them, in my opinion, were starting to go up because of potential rate cuts. What's interesting is that they've all, before the end of last week anyway, they were all going back down again. So it was all, that's why I was saying, hey, I don't think we're going to get a rate cut. And the odds of a rate cut middle of last week had dropped to about 30% chance. And then by the end of the week, it was back up to 70 or 70, maybe 72% is what I heard. So it's been going back and forth, but you can see toward the end of the week, look at the relative strength and all three start to snap back. And that's what I've told members. I said, if we do get the rate cut, I look for these three areas to soar because it looked to me like the market was starting to bet against it. And so now if all of a sudden we are going to have that rate cut, these are areas that still potentially could do very well. I mean, tell me what the Fed's going to do, and I can give you a better indication what the market's going to do. It's about that simple. All right. I know we're having a long session today, but a lot to talk about. I know there's a lot going on. And by the way, I do want to mention to all of our Earnings Beats members in particular that we are coming up on a holiday week. It's going to be a shortened week. We're going to have a little bit more of a holiday schedule. Tuesday's Trading Places live show, we are going to do that. Wednesday's live trading room, that's going to be travel day for a lot of folks with Thanksgiving holiday here in the U.S. on Thursday. So no live trading room on Wednesday. We'll be back the following Wednesday for that. Daily market reports, you'll get one on Tuesday. There will not be one scheduled on Wednesday or Friday. However, if the market, because it is volatile, I'll be watching the market. If there's a need, I will send out an update. We'll get something out to our members. But right now, I'm kind of anticipating if it's kind of a quiet week that we probably will not have anything. No weekly portfolio report this upcoming week. On the weekend, we normally update our portfolios, send out a report. We won't do that until the following weekend. What else? The weekend recap we won't do next week as well. Take the weekend off, so we'll get that going again the following weekend. The video I do over at Stock Charts Wednesday evening, that usually airs on Thursday. Of course, again, Thanksgiving holiday on Thursday. Won't be doing that. But everything next week will return back to normal. Anyway, and chart list will not be updated this week. We'll update them all in the following week. So anyway, we're going to take a little bit of a vacation with everybody else over the holiday weekend. All right. Mag 7 stocks. So here's Apple. I think Apple continues to perform as one of the best among the Mag 7 right now. Still trading near its high, even though technology took a big hit. Microsoft trading as though it's one of the worst. Double top, lost this level of support. So usually you get that same move down as a measurement. So I'm going to say 555 or 553 down to about 493. That's 60 points. That would measure to 433, which would be getting us pretty darn close to this gap support. I don't know if we go down there. I'm just saying that is a possibility. Software, very, very, very weak. Look at software relative to the S&P 500. The good news is it's getting very close to a major relative support level set back in March and April. NVIDIA just came out with earnings, gapped up, and there was nothing left after the gap up. Trying to hold on to this support level right around the upper 170s to about 180. I think we're going to go back down to about the 164 level. That's what I'm looking for here. Meta has been down, but I noticed we are starting to see the AD line move up. For those who, wanted to get into Meta on a pullback, I think this is an interesting one to start maybe accumulating Meta. I'm not saying there isn't more downside. In fact, you can kind of see Meta relative to its peers still downtrending. So I certainly wouldn't take a full position. But if you're somebody who likes to build positions for the long term, I think Meta looks interesting. Google looks pretty good. This is probably the much better play within the internet space. You can see, look at the relative strength here. Google relative to its internet peers, very strong. Tesla, I think Tesla's still holding up. I would watch support probably between about 360, 370. I think that's where maybe we find some more buying on Tesla. Amazon, I don't like what is going on with the AD line. We have had almost nothing but red filled candles since the end of October. Even with the gap up, you can see a sell off. So I'm watching the support level here, double bottom around 212. If that does not hold, I think we're going to go all the way back down into this gap support range between 193 and 200. Netflix, breaking down, but notice the AD line is not at this point, not yet anyway. This, I thought 106 was a very, very big support level. We did close just a little bit below it on Friday. A lot of the areas of the market broke, rebounded. We did not see that on Netflix, unfortunately. So 104, can we get back up through 106? That's going to be the key short term. Again, like Meta, Netflix relative to its internet peers not doing particularly well. So among those three in the internet space, Google definitely seems to be the relative leader for now. Costco, I love the AD line. Stock has been dropping, but did hit major support. This is another one, kind of like Meta, that if you've been waiting for a pullback, stock is down almost 200 points from its high. Probably not a bad time to be thinking about. This is a solid long-term company. Probably not a bad time to at least be thinking about starting to build a position longer term if that's what you're interested in. AMD, I'm not really liking AMD. It tried to hold on to this support level. I have a feeling we're going to go back down, maybe the mid 180s, possibly even to the mid 160s. It did bounce back on Friday. It needs to hold that low and reverse off of it. Maybe it does. I just have my doubts whether it holds. We'll see. But anyway, that's it for those. Last thing I wanted to do is I wanted to show you the areas. So here's healthcare providers. This is one industry group within healthcare not performing well. Let me show you the others. Biotech trending up. Medical supplies trending up. Pharmaceuticals trending up. And medical equipment broke out above 3,050, went back to the 20-day, and then rallied strongly on Friday. This one needs to break above 3,150 ultimately. But I like the group. It's not broken out. It's not doing quite as well as a few of the other groups, but I think it's just a matter of time. I see this group breaking out as well. So what you could do is if you go over to the dashboard at stock charts, scroll down to your scans. If you don't see your scans, then you need to go up here to this gear shift right here. Click on it. Dashboard preferences. Yeah, right here. And make sure your scans and alerts are checked. So if you don't see your scans below, it's probably because this is not checked. So make sure that's checked. And then when you scroll down, you should see it, your scans. And then I'm just going to click on new scan. I want to show you how you can use the stock chart scan engine when you just want to find certain areas. So let's say I'm going to just get rid of this. We'll just click on that new scan. So I have no criteria here. So what I'm going to do is I'm going to go into sectors and industries. Now, what I could do is just pull up healthcare and it'll just do the whole sector. It'll scan the whole sector. Or I could just type in the four groups individually. I'm just going to do healthcare just to make it a little quicker. Add that. So now it's going to run a scan of all the stocks in the healthcare sector. Well, we don't want all the stocks in the healthcare sector. Let's get the stocks in the healthcare sector with Scooter above, well, let's just say, let's limit it a little bit. Let's just say 95. And let's just see what that returns. We could probably do a volume scan, because you can see here, this company only had 1,500 shares. This one had 633 shares. We could have put a volume filter in there. But anyway, just looking at these, we can then sort it by Scooter and then just check, make sure it's got good volume. But here are the stocks in relative strength order according to the stock charts tactical rank, or the Scooter, SCTR. It's an acronym. But there are a bunch of them. Love the stock, Guardant Health, GD. or excuse me, GH. This Indivior, INDV, this was a EB Digest stock from last week. If I pull that one up, just show you this real quick. On long-term monthly chart, I think the highest close daily it's ever had is like 33.60, something like that. And we closed at 32.75, so getting close to a breakout. Anyhow, just wanted to give you an idea how you can run a scan, try and find some of these stocks. Long episode tonight, but again, not doing one next week. So I want to make sure kind of went over several things, different scenarios, so that you can kind of at least be thinking a few things. Again, my long-term view, bullish. I'm not questioning it. I'm bullish. Short term, there's a lot of mixed signals out there right now. And I really do believe it comes down to what the Fed does on December 10th. I think they need to cut. I think Wall Street will receive that well. If they decide that they are going to pause again, I would not be surprised to see selling start to pick up a little bit like we saw back earlier in 2025. Hate to say it, but hey, we've had 4 bear markets since 2018, cyclical bear markets, and I think the Fed's caused 3 of them. There's nothing saying they couldn't cause a 4th one. And, if you continue to leave rates too high, we saw the unemployment rate jump to 4.4%. We know from the shutdown that the economy probably has weakened even further. I think it's a big, big mistake if the Fed decides not to cut. That's my 2 cents. Have a great rest of your week. Enjoy your holiday weekend coming up if you celebrate Thanksgiving. And again, we'll be back not next week, but the week after for the next weekend recap. Have a great week, everybody. Happy trading.